Investing is important. It's a way to make your money work for you, rather than you working for your money. By putting your money into various investment vehicles, you can potentially grow your wealth over time. This can help you achieve financial goals, such as buying a house, funding your education, or even retiring comfortably. But why is it even more crucial to start investing at a young age? Investing young is even better. When you start early, you give your investments more time to grow. This is because of the power of compound interest, which Albert Einstein once called the eighth wonder of the world. Compound interest means you earn interest on your initial investment, and then you earn interest on your interest, and so on. Over time, this can lead to exponential growth. The earlier you start, the more time your money has to grow. Think of it like planting a tree. The sooner you plant it, the longer it has to grow and the bigger it can get. Similarly, the sooner you start investing, the more time your money has to benefit from compound interest and market growth. Imagine a snowball rolling down a hill. At first it might be small and slow, but as it continues to roll, it picks up more snow and gains momentum. This is similar to how investing works. As it rolls, it picks up more snow, getting bigger. Investing is similar. The longer you stay invested, the more your money can grow. This is why starting young is so advantageous. You have the benefit of time on your side. Your money grows over time. With each passing year, your investments can increase in value, especially if you reinvest your earnings. This can lead to significant wealth accumulation over the long term. This helps you build wealth. By starting young, you can take advantage of the compounding effect and potentially achieve your financial goals sooner. Whether it's buying a home, traveling the world, or retiring early, investing can help you get there. Starting young gives your investments more time to grow. This means you can afford to take on more risk, as you have more time to recover from any potential losses. Over the long term, the stock market has historically trended upwards, so starting early can give you a better chance of seeing positive returns. This means you can potentially earn more money in the long run. By giving your investments more time to grow, you increase your chances of building substantial wealth. This can provide you with financial security and freedom in the future. Don't wait to start investing. The sooner you begin, the more time you give your money to grow. Even small amounts invested regularly can add up over time. It's never too early to start planning for your financial future. The sooner you begin, the better off you'll be. Investing young sets the foundation for a financially secure future. So take that first step today and start investing in your future. Compound interest is like magic for your money. It's a powerful financial concept that can transform your savings and investments over time. It's the interest you earn on your initial investment, plus any interest you've already earned. This means that your money starts to grow at an accelerating rate, creating a snowball effect. Think of it like this. You invest £100 and earn £10 in interest. The next year, you earn interest on £110, not just £100. This process continues, and over time, the amount of interest you earn each year increases. The beauty of compound interest lies in its exponential growth. The longer you leave your money to compound, the more significant the growth becomes. It's like planting a tree. The longer it grows, the more it flourishes. This snowball effect can lead to significant growth over time. Imagine a snowball rolling down a hill, gathering more snow and growing larger as it goes. That's how compound interest works with your money. The longer your money compounds, the more you earn. Time is a crucial factor in the equation. The earlier you start investing, the more time your money has to grow. This is why financial advisors often stress the importance of starting early. That's why starting young is so powerful. When you begin investing at a young age, you give your money the maximum amount of time to benefit from compound interest. Even small amounts can grow significantly over decades. Even small contributions can grow into a substantial sum over time. Consistency is key. Regularly adding to your investments, no matter how small the amount, can lead to impressive results thanks to the magic of compound interest. So, start early, be consistent, and let your money work for you. There are many ways to invest your money. Whether you're looking to grow your wealth, save for retirement, or achieve other financial goals, understanding the different investment options available to you is crucial. Each type of investment comes with its own set of risks and rewards, and it's important to choose the ones that align with your financial objectives and risk tolerance. Each option has risks and potential rewards. For instance, investing in the stock market can offer high returns, but it also comes with a higher level of risk. The value of stocks can fluctuate significantly in the short term, but historically, they have provided strong returns over the long term. It's essential to understand these dynamics before diving into stock investments. Stocks represent ownership in a company. When you buy stock, you're essentially purchasing a small piece of that company. This means you become a shareholder and have a claim on part of the company's assets and earnings. Stocks are traded on stock exchanges, and their prices are influenced by various factors, including the company's performance, industry trends, and overall market conditions. When you buy stock, you're buying a small piece of that company. This ownership can provide you with dividends, which are a portion of the company's profits distributed to shareholders. Additionally, if the company performs well and its stock price increases, you can sell your shares for a profit. However, if the company performs poorly, the stock price may decline, leading to potential losses. Bonds are like loans to governments or companies. When you purchase a bond, you are lending money to the issuer in exchange for periodic interest payments and the return of the bond's face value when it matures. Bonds are generally considered safer investments compared to stocks, but they typically offer lower returns. They can be a good option for conservative investors looking for steady income. You lend them money, and they promise to pay you back with interest. The interest rate, or coupon rate, is fixed at the time of issuance and remains constant throughout the life of the bond. Bonds can be issued by various entities, including governments, municipalities, and corporations. The risk level of a bond depends on the issuer's creditworthiness. Government bonds are generally considered low risk, while corporate bonds can vary in risk. Mutual funds and ETFs are baskets of stocks or bonds. These investment vehicles pool money from multiple investors to purchase a diversified portfolio of assets. Mutual funds are actively managed by professional fund managers, while ETFs, or exchange-traded funds, typically track a specific index and are traded on stock exchanges like individual stocks. Both options offer diversification, which can help reduce risk. They allow you to invest in a diversified portfolio with a single purchase. This diversification can help mitigate the risk of individual investments performing poorly. Mutual funds and ETFs can be tailored to various investment strategies, such as growth, income, or balanced approaches. They are suitable for investors who prefer a hands-off approach and want professional management or automated tracking of their investments. Real estate involves buying, holding, or renting property. Investing in real estate can provide a steady income stream through rental payments and the potential for property value appreciation over time. Real estate investments can include residential properties, commercial properties, or land. Each type of real estate investment has its own set of considerations, such as location, market conditions, and property management. It can be a good long-term investment but often requires a significant upfront investment. Real estate can also offer tax benefits, such as deductions for mortgage interest and property taxes. However, it is important to consider the costs associated with property maintenance, management, and potential vacancies. Real estate investments can be less liquid than stocks or bonds, meaning it may take longer to sell a property and access your funds. Stocks can be volatile. Their prices can go up or down quickly. This makes them a riskier investment. However, stocks also have the potential for high returns. Over the long term, stocks have historically outperformed other asset classes. Investing in individual stocks can be risky. It's important to research companies thoroughly before investing. Section 5. Bonds, a safer bet. Bonds are generally considered less risky than stocks. They offer more stable returns. Bonds typically pay a fixed interest rate over a set period. This makes them a good option for income-seeking investors. However, bond returns are usually lower than stock returns. They may not keep pace with inflation. Section 6. Mutual funds and ETFs. Diversifying your portfolio. Mutual funds and ETFs allow you to invest in a variety of stocks or bonds with a single purchase. This diversification helps spread your risk. It can reduce the impact of any single investment performing poorly. Mutual funds and ETFs are managed by professionals. They choose investments based on specific investment objectives. Section 7. Real estate investing in bricks and mortar. Real estate can be a good long-term investment. It can provide rental income and potential appreciation in value. However, real estate is illiquid. It can be difficult to sell quickly if you need access to your money. Real estate also requires significant upfront investment. You'll need a down payment, closing costs, and ongoing maintenance expenses. Section 8. Starting small, dreaming big. You don't need a lot of money to start investing. There are many affordable options available. Consider starting with a small amount of money each month. As your income grows, you can increase your contributions. Many online platforms allow you to invest with as little as £10. These platforms often have low fees and make investing accessible to everyone. Section 9. Your journey to financial freedom. Investing is a journey, not a sprint. It's important to be patient and stay disciplined. Don't panic if the market goes down. Remember that investing is a long-term game. By starting young and investing consistently, you can build a solid financial foundation for your future. Start investing today and watch your money grow.